Silvey, and I am doing my end of year Excel presentation and chapter review. And the chapter that I chose to do this review over was chapter 16. Chapter 16 was titled Cost Allocation, Joint Products, and Byproducts. In this chapter, we talked about allocating joint costs and the methods that you can do this by, such as sales value at split-off method, physical measure method, net realizable value method, and constant gross margin NRV method. The sales value at split-off method allocates joint costs to the joint products produced during the accounting period on the basis of the relative total sales value at split-off point. This method uses the sales value of the entire production, not just the quantity sold, and it follows the benefits received criteria of cost allocation. The sales value at split-off method will be demonstrated in the first example in my Excel presentation. The physical measure method allocates joint costs to joint products produced during the accounting period on the basis of a comparable physical measure, such as relative weight, quantity, or volume at the split-off point. This method allocates joint costs on the basis of the number of gallons or whatever unit is used in a specific situation, so the cost per gallon is the same for both products. Byproducts are often excluded from the denominator when the physical measure method is being used. This will be demonstrated in the second example of my Excel presentation. The net realizable value method allocates joint costs to joint products produced during the accounting period on the basis of their relative NRV, which is final sales value minus separable costs. This method is usually preferred over the sales value at split-off method when selling prices for products at the split-off do not exist. This method is also often implemented using simplifying assumptions. The NRV method will be shown in the third example of the Excel presentation. The last method I'm going to talk about for this chapter is the constant gross margin percentage NRV method. This method allocates joint costs to joint products produced during the accounting period in such a way that each individual product achieves an identical gross margin percentage. The gross margin percentage NRV method has 3 steps that you must follow. The first step is computing the overall gross margin percentage. This is based on the final sales value of total production during the accounting period, not total revenues. Step 2 is computing the total production cost for each product. The difference between the final sales value of total production and the gross margin yields the total production cost that the product has to bear. The last step is to compute the allocated joint costs. This is when the separable costs for each product are deducted from the total production cost that the product must bear to obtain the joint cost allocation for that product. The constant gross margin percentage NRV method is the only method where products can receive negative allocations and will be demonstrated in the last Excel example. Now here is the Excel that goes along with chapter 16. The info sheet just kind of gives us information from the book with joint costs, beginning inventory, sales, ending inventory, and then joint costs for different products, separable costs, beginning inventory, production, sales, selling price per gallon, among other things. The first example is the split-off method, and I'll be referring to just the cream in this video because you compute the cream and liquid skim the same way, so we don't need to do both of them. And for all 4 of these examples, product B is going to be panel B, is going to be similar for all of the examples, but I will talk about them briefly anyways. So in panel A, this is allocation of joint costs using sales value at split-off method. To find the sales value, which is $200,000, you take the production times the selling price, so that's found over here in the info sheet. For weighting, you just take the sales value of the product, or the total production at split-off point, divided by the total to get your weight. For joint costs allocated, you take the weight, which is 40% or 0.4, times the total joint costs given up here, which is $400,000. And then for joint production cost per gallon, it gives a description right here, but you take the joint cost allocated divided by the total production, which is given over here, which is 25,000. And for panel B, for revenues, this is pretty basic. We've already learned how to do this, but you take the sales times the selling price over here And then for the production cost or under the cost of goods sold category, you just take the weight, so 0.4 again, times the total joint cost allocated, which is right here. No, actually over here, sorry. To get your 32,000 or 160,000. For the deducting ending inventory, you take the ending inventory from the info sheet, which is 5,000, times the joint production cost per gallon, which is right here, $6.40. And then that gets you 32,000. And then for cost of goods sold, it is just the production cost minus the deducting ending inventory. It gets you that 128,000. Gross margin, as always, is revenues minus cost of goods sold. And then the gross margin percentage, which is 20% for all of these, is just the gross margin divided by revenues. So this means that the gross margin is 20% of the overall revenues. For the physical measure method, which is example 2 from this homework assignment, first you're trying to find the physical measure of total production gallons. And this is just from the info sheet. So right here. The weighting is the same as the split off, but it's physical measure divided by total physical measure. So 25,000 divided by 100,000. This is computed the same as we found, as how we found it on the split off method, like I said. Joint cost allocated is the weight, so 0.25 times total joint cost given over here, which is 400,000. So that gives us 100,000. And then joint production cost per gallon is joint cost allocated 100,000 times, or divided by, times 400,000. Oh wait, actually, sorry. It is 400,000 divided by the weight. I don't know. Okay. Revenues is the same. Sales times selling price given from the info sheet. Production costs is the weighting, so 0.25 times total joint cost allocated from the info sheet actually. So that'll give us 20,000. Deducting ending inventory is the ending inventory from the info sheet times the joint production cost per gallon, $4, gives us 20,000. Cost of goods sold is just the difference between the production cost and the deducting ending inventory. And the gross margin is the same, revenues minus cost of goods sold. And the gross margin percentage is also the same, gross margin divided by revenues. So in this example, you see that that the gross margin is 50% of revenues for cream, but for liquid skim, it's actually 0%. So that's a big difference compared to the split off method. For the NRV method, in this example, we're going to be focusing on buttercream. And like I said, you use the same formulas to find both the buttercream and condensed milk, so I'm just going to focus on one of them for this video. But final sales value is just from the info is the production from the info sheet times the selling price per gallon. So that is over here, production and selling price per gallon. The separable cost, which is next, is just given on the info sheet over here, 280,000. And this is just the difference between the final sales value and the separable costs. To get the weight, you do the same general calculation, but it's the NRV at the split off point divided by the total. For joint cost allocated, you do the joint cost on the info sheet, so 400,000 times the weight right here. The production cost per gallon is going to be the separable cost plus the joint cost allocated divided by the production on the info sheet. So down here. Revenues is just pretty much the same as the other ones. It's sales times selling price over here. Joint costs are the weight right here times the total joint cost from the info sheet. Again, 400,000. Separable costs were given on the info sheet over here. The production costs are the sum of the joint costs and the separable costs. The ending inventory, deduct ending inventory here, is the ending inventory from the info sheet, right here, 8,000, times the production cost per gallon, which is 1950. Cost of goods sold is production cost minus the deducting ending inventory gives you cost of goods sold. Gross margin is the same as the previous ones, revenues minus cost of goods sold, and so is the gross margin percentage is also found the same way, gross margin divided by revenues. And like I said earlier, panel B is computed pretty similarly throughout all the examples. The last one is the constant gross margin percentage NRV method, which is a little more detailed than the others. There are 3 steps in the first panel, and then panel B again is similar. So for step 1, the final sales value of total production during the accounting period. You take the production times the selling price per gallon given on the info sheet over here, and then you add the same thing for the buttercream and the condensed milk. So it will be 20,000 times 25 plus 22 times 50,000 is how you're going to get the final sales value. The deducting joint and separable costs is the total joint cost given on the info sheet plus the buttercream separable cost and the condensed milk separable cost. And that is how you compute this category. So the gross margin is just the difference between these again. And the gross margin percentage is the gross margin divided by the final sales value. So that gets us 0.25 or 25%. And then again, focusing on the buttercream for the rest of the calculations, the final sales value is the production times selling price again. So $20,025. Deducting the gross margin is the gross margin percentage, so 25%, times 500,000 gets us 125,000, and you're going to deduct that from the final sales value to get the total production costs. In step 3, the separable costs, you're going to deduct those, and they were given on the info sheet, so 280,000 right here. And then once you subtract the separable cost from the total production cost, you get the joint cost allocated for this problem, or for buttercream. Lastly, panel B, find revenues again by multiplying the sales and the selling price from the info sheet over here, 12,000 times 25. The joint costs were given from above as it says, so right here. Separable costs were also given above, right here. The production costs are the joint costs and the separable costs added together. The ending inventory is the production costs from above divided by the production from the info sheet. So that would be 300